Hi everyone, my name is Mark Quinn. I'm a tax advisor and a chartered financial planner based in Portugal. And in this video, I'm going to be looking specifically at buying property in Portugal. So we're going to be looking at the buying process. We're also going to be looking at the different ways you can own property here. We're going to look at the tax issues associated with buying property. And we're also going to look at the tax issues associated with moving to Portugal if you are looking to make Portugal your main home. I'm going to also look at wills and succession planning and some of the things that you need to take into account when you're buying property here. So first of all, just to reassure you that the Portuguese property market is a strong and stable property market. There's strong legal processes to protect both the buyer and the seller. And also transactions can be completed relatively quickly in as little as 4 weeks. So with regard to the actual buying process, the first stage and an optional stage is using a reservation. And with that, you can make a small payment, typically between €3,000 to €5,000. And you're doing that to allow the seller to temporarily withdraw the property from the market. And the period is typically 15 to 30 days, and that will give you and your lawyer time to do due diligence on the property and allow you to make an informed decision. So what the lawyer is going to be looking at is the registrations for the property, making sure that the property is unencumbered, looking at the legality of the actual building itself and the structures, and also making sure that the sale is actually fully legitimate. And the lawyer will provide you with a written report of their findings so you can make a fully informed decision. Surveys aren't actually compulsory in Portugal, but they are recommended to be done as early in the process so that you don't get tied up into a legal agreement without knowing all the facts. So once your lawyer has carried out all their checks and the surveys, etc., the next stage will be for you to move to what's called a promissory contract. So the promissory contract is a contract that's signed by both the buyer and the seller, and it binds them into exchange of the property. Now the contract will include all the salient details, so it will include the identification of the buyer and the seller. It will include the price agreed on, the date that the exchange is to be made. It will also include itemised lists of everything that's included within the price of the property. And critical to the promissory contract are the terms or the penalties that are imposed if either party withdraws from the contract. And typically what the buyer has to put down is 10% of the property purchase price, and that's the amount he loses if he withdraws from the deal. And similarly, the seller also is penalised. So if they take the property off the market and don't conclude the contract, then they have to meet twice the payment. So they have to put up 20% as a penalty for withdrawing from the contract. After the promissory contract is finalised, then the next stage after that is the signing of the deed of purchase and sale. That's signed by both the seller and the buyer, and it's witnessed and checked by a lawyer or notary. And then the final stage after that is that the property is registered with the land registry. So in terms of actually how to purchase the property, historically there have been two key ways of buying a property in Portugal. You either buy it in your own individual names, so it's a personal property acquisition, or what has been common in the past is actually buying the property through a corporate structure. So a company buys the property and you own the shares of the company. Now historically that had tax benefits, but due to tax changes over recent years and due to the increased complexity of holding properties through company structures, this has become a less attractive route. And sometimes it can also put buyers off from purchasing the property. So again, a lot more people are choosing to buy properties within their own names rather than using a company structure. Also, something to take into account if you are a resident here or you're thinking about becoming residents here in the future, if you own a property in your own name, If you sell that property in the future, the default position here in Portugal is that you pay capital gains tax on any appreciation in value. Now, one way of avoiding that tax is by reinvesting the sales proceeds into another property, either here in Portugal or elsewhere in the EU. And that exemption is only available if you own the property in a personal capacity. So it's not available if you own the property through a company structure. So again, the trend has been for people to avoid using companies to purchase the property. But an individual analysis is always needed, so speak to your advisor down here in Portugal to see which route is most appropriate for you. In terms of the tax implications of buying a property in Portugal, you have two key issues really. There's the issues and the tax associated with the property itself, and then there's the tax implications on you as individuals, which we'll talk about later. So looking at the property itself, the two real key initial tax payments you have to think about are the property transfer tax, which is known as IMT, and for properties of €1 million plus, that will be 7.5%. The stamp duty is a flat rate of 0.8%, and other fees you need to think about are legal fees and notary fees. But to give you an idea, for a property valued around 500,000, you're looking at about 8% in total fees. Some people suggest to allow 8 to 10% for total fees, including all your tax and associated legal expenses. If we then look at the ongoing tax issues, you've got one key tax, which is EIMI, or council tax, EMI. And that's at a band of 0.3 to 0.5% depending on the value of the property. You also have additional IMI, which is levied on properties that are valued at more than €600,000 per person. So if you're a married couple, you've got an allowance of 1.2 million. Anything above that is taxed. And just to give you an idea, for properties valued at between 1 million and 2 million, the additional tax charge will be 1% a year. Looking at the tax implications for you as individuals, there's only really one key tax to think about, and that's rental income tax if you are renting the property out. And the tax treatment is split depending on whether you're a tax resident here or not. If you're not a tax resident here, you're going to pay a flat 28% tax rate on the rental income. If you are a resident here, you have a choice. You can either pay the 28% flat rate of tax, or you can combine that income with your other income from different sources and apply the standard scale rate. So this is the standard banding system whereby the level of tax paid depends on what band your income level falls into. From a succession point of view, we can look at succession planning in two different ways. We can look at the tax aspects and the control aspects. So from a tax aspect, first of all, the good point is that Portugal doesn't actually have inheritance tax as such. Inheritance tax was abolished here in 2003. However, there is a stamp duty charge. So that's levied on successions and gifts received, but it only applies if you're leaving it to people outside of your family. So if you're leaving it to direct line descendants or ascendants or between spouses, then it's actually tax-free. Now, you also have to think about the law of your nationality. So if you're coming from the UK inheritance tax system isn't determined by the fact that you live there or not, it's determined by your domicile. This is quite a complicated subject, and we've got references and guides elsewhere which I'll link to in the description. But what it essentially means is if you originate from the UK, more than likely you will have a UK inheritance tax issue even on your Portuguese property. So even on non-UK assets, you'll still be liable to UK inheritance tax on those assets. Looking at the control aspect of succession planning, then you have if you're buying a property here in Portugal, then you're going to have a non-UK asset, and therefore we recommend you have a Portuguese will to cover any Portuguese assets. Now, Portuguese properties can be included in a UK will. There's no issue there. However, because you've got a mismatched legal system and a mismatch in languages, we always recommend people to have a separation of wills and assets. So any UK wills cover UK assets, any Portuguese property and assets are covered by a separate Portuguese will. If you have got multiple wills, they should refer to each other but not conflict with each other. Just also bear in mind that Portugal has what we call forced heirship principles. So unlike in the UK where you can leave your assets to anybody you wish, in Portugal the state can step in and dictate how your estate should be distributed. But there is one way around that, and that's by being aware and elect to use what's called the Brussels 4 Directive, Brussels 1V, which is a European Union directive which allows you to use the law of your nationality in the reading of your will. So you could have a Portuguese will, but you could have it distributed in line with UK legal principles. The final aspect I wanted to consider in this video is if you're looking to buy a property here in Portugal and actually make it your home, rather than it being a holiday home. If it's just a holiday home, then you don't have to think about residency. If you are looking to move to Portugal full-time as your new home, then you need to think about how you establish residency. Now, if you have another EU passport, citizenship, then it's going to be very easy for you because as an EU citizen, you have an automatic right to establish residency in Portugal. If you don't, so if you're British or coming from outside the EU, you now have to go through one of several visa processes, the most common being the Golden Visa and the D7 Visa. Now, in a way, they're the polar opposites of each other because the Golden Visa requires you to make a substantial investment into Portugal, whether that be in the form of property or investment funds, and it will be at least €350,000. But the positive point of that is that you're not required to spend a substantial amount of time here in Portugal. It's just 14 days. So it gives you flexibility, not a very large minimum time spent here, but it is quite a costly route. Conversely, the D7 visa, you don't have any substantial initial outlay. All you need to prove is that you're in receipt of some kind of regular income, be it from dividends, pension, rental income, interest, any passive income, and in some cases remote working also qualifies. But the downside, or it could be considered a downside for many people, is that you need to be here at least 6 months a year, and that in turn makes you a tax resident in Portugal, which the Golden Visa doesn't. Now again, tax residency here may or may not be a bad thing for you. In fact, for many clients, they're actually coming to be a tax resident here because it's so good for them. And that's as a result of the non-habitual residence scheme, which is a 10-year tax incentivized scheme, which is eligible for new residents of the country. Again, we cover these aspects in our other guides and other articles and videos we've linked to on our website, so please look at those. I'm also going to be doing another video and another guide focusing specifically on selling Portuguese property, because this video has focused on the acquisition process and becoming a resident here. Again, we're going to be looking at things from the opposite side of the transaction when you're selling property here and the issues you need to take into account. So that's it from me for now. If you've got any questions, please let me know either in the comments or you can email me direct, and I look forward to hearing from you. Thank you.